What's up, everybody? Cameron Foose here with FooseAlerts.com, and it is finally here. Foose 4 Part 2 is finished. It has been, a long time coming. It actually took me a lot less time to finish this one as opposed to the Foose 4 DVD. This one was a little bit more organized for me, just recording DVD or trade lessons along the way rather than trying to pile everything together at once. This was a good experience, and you're going to learn a lot of great stuff. The market's changed a lot, so there's a lot of new things that have been implemented into the Foos 4 overall strategy. First off, hopefully you already know who I am, being that you've probably already watched, or you should be have watched, the Foos 4 DVD. But I am the founder of FooseAlerts.com, formerly the TechnicalTrader.net, which I started in 2006. I started trading in 2005. About a year later, I started up the technicaltrader.net after, feeling like I kind of had a knack for the market. I built my reputation out at a different website called 3stocksonfire.com. Won a stock picking contest over there, and, was just feeling good about the things that I was learning, and just felt like this is what I wanted to do. I always wanted to be a stockbroker growing up, and, it wasn't until 2005 when I first put my money into the stock market, and of course lost it all right away trading stupid penny stocks. But you got to live and you learn. You learn to what works, and everybody finds their own niche. And this is mine. I figured out a strategy that works, and my plan is to be able to teach it to anybody that's willing to learn. And you have to be willing to learn. You have to be able to put in the time if you want to make money in the stock market. And so, been doing this since 2006, and I'm still here. We went through the entire economic collapse. Things were definitely extremely rough during that time, and trading was slow. There was about a month and a half or two when I just wasn't really even trading at all, just because the market was so crazy and irrational, and I was, just figuring things out. And then the market kind of bottomed out in March of 2009, and we've been killing it ever since. So there's about 2 months of downtime out of that whole economic collapse, but we're still here, still killing it, still just learning every day, and finding new strategies to implement into the Foos 4 strategy. And that's what this DVD is all about. Part 2 of my epic first DVD that got rave reviews. Since then, I've made a lot of changes. I'm now a Profitly guru, thanks to Tim Sykes bringing me on board with his team. I started my first Profitly account in 2011. I'm up over $330,000 in profits since then. Today is end of September 2012, so about a year and a half, a little over a year and a half, I've made $330,000 using this exact strategy. So it's a strategy that works. You just got to be able to put in the time and learn it. And if you learn something that works, use it and stick to it. I don't mess around with other stocks. I don't short stocks. I don't follow Tim Sykes and his strategy. That's his thing. I suck at shorting. This is my strategy. This is my niche. It's what works for me, and my goal is to be able to make it work for you. All right, so moving on now, we're going to talk about what is the purpose of this DVD. What's kind of my goal, and what are you going to learn here? First of all, obviously this is basically just going to expand your knowledge on the evolution of Foos 4 patterns. A lot has changed since the last DVD has come out. I started working on the original Foos 4 DVD, I think, in maybe late 2008, early 2009. So, we're coming up on the end of 2012. So, I've changed a lot of stuff. The market has changed. There's so many, quantitative trading. There's lots of machines out there that are trading that, trigger things in the market, stops and fat finger things, basically where a computer system screws up and, things go haywire. And there's been a lot of just extreme days of volatility, and it's just been a way more volatile market. So you need to be able to react on much shorter term basis and be able to kind of take advantage of a really short term opportunity, or protect yourself because of all of a sudden the market flips on you, or your position all of a sudden turns around. So this is kind of just gonna expand your knowledge on a more volatile market. In addition, we're going to be talking about intraday trading action, or day trading strategies. In the Foos 4 DVD, the original, I don't even illustrate or mention an intraday chart whatsoever. It's just solely based off my core strategy of swing trading. Swing trading is holding a stock for more than one day. Day trading is obviously in and out of the stock in the same day. So, as I said before, in the Foos 4 DVD, I'm only illustrating daily candles. But on an intraday level, every daily candle tells its own story on an intraday basis. So, for example, let's take a look at stock ticker SNTA here from today. If we look at each one of these candles, that's just one day out of any given day, and within that candle, each candle has its own story that had, a multitude of different patterns forming up on an intraday scale. So looking here on SNTA, we'll just pull up the 1 day, 1 minute chart. You can see here this thing opened up at about 940, came all the way down to 870, ripped all the way back up to 978, so almost ran up a whole dollar from there. And it was all over the place today. So the market is extremely volatile. These stocks move up and down very quickly, and there's opportunities within each daily candle if you know how to identify the right intraday patterns as well as how to trade them. So every single candle on a daily scale has its own whole entire story that's written on an intraday basis. So it's something that I've way more adapted to just because the volatility has changed, and there's opportunities every day on these intraday charts to take advantage of. And it's also, the goal is to implement that into the Foos 4 daily chart swing trading strategy. This just kind of helps you, potentially get better entries, potentially take your profits quicker, or sometimes potentially, enable you to cut your loss quicker because you see something on an intraday chart that isn't showing on a daily chart. But ultimately, the whole reason for this is to learn how to implement intraday charts into the core strategy of swing trading, the daily charts, and maximize your success as a foosalerts.com subscriber. Okay, so what is day trading? I'm assuming and hoping that if you're this far in the game with me, if you're on Foos 4 Part 2, or you're interested in trading, you at least know what day trading is. Obviously, it's buying and selling a stock in the same day. Pretty self-explanatory. Whereas swing trading, is buying and selling a stock, over the course of 1 to several days. Swinging as in a multi-day hold. But day trading, this is an extremely fast-paced and highly demanding strategy. I don't prefer to just day trade. My core strategy is swing trading. That's what I would love and prefer to do on every one of my trades. But the market is loco. It's crazy. And a lot of the times, I've maybe even become more prone to day trading over swing trading, and there's ups and downs with that. I'll be getting into that in a minute. But day trading is extremely fast paced. This is on the edge of your seat trading. Once you get into a day trade, you're sitting there. You need to be able to sit there and watch this stock and be prepared to, quickly click the buy button or sell button, and your emotions need to be in check and controlled. A person that's completely manic and panicking all the time and just can't, just take a deep breath and let a stock kind of do its thing, you're gonna have a heart attack day trading, basically, and you're probably not going to do very well because day trading is very fast paced and it's a true test of one's trading discipline. Some people can day trade, or swing trade. There's a lot less stress involved in that. You buy a stock, you pick a stop, you let it ride out and do what it wants. But with day trading, it's really a true test of your trading discipline. If you can't, keep your mind in a peaceful place, you're not going to be able to do it successfully. And also as a day trader, you need to be able to be prepared to sell a stock right away if it flips on you. Cut your loss very short, because when a day trade, these things go up and down very quickly and can quickly reverse on you. For example, let's take a look at a stock today that I was in that I had to quickly get out of the position due to it reversing on me right away because the pattern changed so quickly. All right, so here's ticker ROSG. This is actually a stock that I just recently made about $4,000 on, and on a swing trade, it was 2 days. So today was an example. I actually lost about just shy of $500 on a quick day trade that quickly reversed against me and actually protected myself against a much larger loss just due to the fact of what the intraday chart looks like. And this stock, reversed quite a bit. From the daily perspective, this thing was in a revival pattern formation. So, obviously the lead-in trend here is bearish. Formed out this great-looking triangle formation. It did have a little piece of news out this morning and started gapping up. We were up about 7%. And it looks like we could, potentially break this neckline and continue above this, low 720 area. About there was kind of the neckline breakout, and hopefully push up towards, $8 or $9 per share as a potential swing trade. Foods 4 Part 2 wise, that the whole goal of this is learning intraday charts. So this is kind of just a quick example. I'm not going to go into complete detail of F patterns yet, which is what we're going to be learning, but this was just kind of an example of me trying to implement both sides of the story from the intraday perspective over here. This is a 2-minute chart into the daily chart, which was a potential revival pattern, but due to this not working out and being able to study and know the intraday chart, I had to change my mind very quickly, and I protected myself from a much greater loss than I actually did have. So basically, I was looking here at the intraday chart. This is the beginning of the day right here. This candle, we gapped open. We're up about 7%. And, I was waiting to see this kind of form up here. Basically what an F pattern is, what we're going to be learning about intraday breakouts is, mini triangle breakout patterns on an intraday scale and how to trade those. So that was looking like this was potentially getting ready to form up a nice looking triangle breakout pattern here on this intraday scale just right here, and combining that with, that neckline here at about 720. The daily chart, that's using both time frames to kind of trigger and gauge your entry here. So I bought in eventually at 720 and alerted this right here, hoping to see this break out new highs, get a rip above this line here, which is also this same exact line here drawn. These are in conjunction. If I move this up and down, that's going to move this line up and down. So breaking out above here on the daily chart, as well as this formation on the intraday scale, that was an indication of this potentially just ripping forward here today and potentially going. But quickly, as after I bought in at 720, we spiked out at about 730, made about 10 cents, on that breakout. But it didn't last long whatsoever. Quickly broke down the 13 EMA here on the 2-minute chart. I ended up selling quickly afterwards. It happened so quick. That's the other thing about today's market. These things, drop from 710 down to 680, almost 30 cents, and that's in a matter of 2 minutes right there. So things happen very quickly. I got out later than I wanted to. I didn't get out until, I believe, around the 690s, but that first sell trigger was, in fact, around here at about 710. And things happened so quick, all of a sudden 20 cents was gone within, about a minute there. So I ended up getting out in the 690s, but if we go forward here, that was actually the sell trigger, and because I was looking at the intraday chart, I was able to cut my loss quicker, and this thing came all the way back down, closing it in, almost as low as $6 per share. So nearly 90 cents lower it went from my actual sell trigger after that quick false breakout, just looking at the intraday chart. So, knowing the intraday scale of things and how intraday charts can work, it's very beneficial, and sometimes you can cut your loss extremely more short. So this was today's candle right here. So just looking at that, that's all you really see. But if you look at the intraday's chart, there's a whole different story going on here that you can kind of read and gauge your position off. So this is a good example of my goal was to try to trade this revival pattern. My entry was kind of gauged on this intraday F pattern breakout here, trying to get in at 720. It quickly turned around. It did not get that breakout. I sold on this breakdown, just all based on the intraday chart. So my kind of entry and exit was all based on the intraday over here, but my overall goal of the trade, and kind of the whole reason why I was interested in this stock for the most part was that it was actual foods for revival potential. So this is a great example. Like I said before, the goal of this DVD is to kind of learn how to implement intraday patterns into the overall foods for strategy. So the majority of my trades are you know basically based still around the FUS4 patterns, the revival, survival, gold, and force pattern. Almost all my positions are still based on that core strategy. That's what I'm looking for in the daily chart. Now I'm just kind of trying to implement these other intraday patterns into that as well. Another example, one that did break out big was SNTA. This was actually a force pattern that broke out. As you can see here at about 850, if we go back to the intraday scale chart, this did actually break out of this intraday breakout pattern here. This was another thing, just showing how crazy these frickin' stocks are these days. This thing opened up at 780, spiked up to 834 randomly. This is like quantitative trading machines in action right here, going from 830 down to 756 within minutes. So this actually, I was on Foos TV talking about this stock, saying, hey, we got news out here, potential force pattern, and this was at 790. I was talking about this right at the open. This was the opening of this day and ended up closing at 938 almost. All right, now there are actually some day trading restrictions. Nobody can just go in and start day trading. There's something that's called the pattern day trading rule. Short PDT is kind of what the shortened version of that is. But there's actually a limit on your actual day trades that you can execute. If you have an account with a balance of under $25,000, you are actually limited to only 4 round trip day trades within a 5-day period. So basically, during a week of trading, you can only make 4 round trip day trades. Otherwise, you can actually get your account locked for up to 90 days. That's 3 months of not being able to trade because you went over your day trader limit. I believe the reason for this is just day trading is an extremely hard thing to do. It takes a lot of practice, and if you're sitting there, day trading a lot, you're going to burn up your account in commissions. As well, potentially lose a lot of money because you're sitting there throwing all your money away just over trading. So I think it's just kind of a regulatory thing so that everybody doesn't blow their account up right away because they have unlimited day trades to screw themselves over all day long. So the SEC put a cap on this of 4 round trip day trades within a 5-day period. And accounts that have over $25,000 can day trade as much as they want. So a lot of people that start out in the stock market have to work their way up to getting beyond that $25,000 mark. I went from $10,000 to nothing, lost it all, put in another 5, lost it all, and then put in another 5, started with that and rebuilt from there. Now I trade on average with $100 to $150,000 in my account at all times. I always keep it in between that range. That's what works well for me. In all my profits, I'm either taking out and spending, and going on vacations, paying taxes on my business side of things, or account building, or just doing whatever with it. But typically for me, I'm trading with about $100 to $150,000 in my account at all times. I had to build my way up under the PDT rule over 25,000, and once you get over that $25,000 mark, it really just kind of gives you a little bit sense of relief because you can take more advantage of different trading opportunities. And take advantage of cutting your losses short. If you're on your 4th day trade and all of a sudden you go into another stock and you can't make that day trade because you're going to get your account locked, it can be extremely stressful. But fortunately now these days there are brokers that allow you to bypass the PDT rule with as little of account as $2,500. So it's a special broker. If you're watching this DVD and you're under that $25,000 mark, go ahead and go to foosalerts.com, click the contact button, send me an email, and I can give you details on this broker. It's not to go. There's not some loops you got to go through, as well as some extra little tidbits. Commission wise, you kind of have to get pay your way to be able to get bypass that PDT rule. So there's going to be some commission fees and whatnot on a per trade basis, but that's all negotiable with that broker. But it can certainly help you get past that $25,000 mark by opening up your opportunities by getting rid of that PDT rule. So it's definitely something I highly recommend if you're interested in that. If your account is under $2,500 and you want to get some help trying to get past that $25,000 mark, so you can use a normal broker, which is what I use. Speedtrader.com is my broker. You can also send me an email about them. I can get you in contact with my guy, and you can negotiate the terms with him and whatnot. But that's just kind of goes with what I want to talk about, day trading restrictions, and we're moving on to the next slide. All right, so day trading has both ups and downs to it. So first, let's talk about some of the benefits of day trading. First off, it helps capitalize on very short-term profits. Sometimes just being able to identify an intraday chart, sometimes I'll get in and out of a stock in a couple minutes and make $500 to $1,000 on a very short-term scale within 5 to 10 minutes, and that might have been all that stock had going for it all day, was just that quick short-term pop, get in and out, make that money, and move on. So day trading, when you can identify very short-term patterns like that, sometimes you can just get in and out and make a nice little profit and walk away. So you can capitalize on very short-term gains, which is definitely beneficial when the market's kind of very choppy and it's not trending. As far as swing trades go, when you're swing trading, you want to see the market trending in a general direction so that stock can continue to go up as you hold it. In a very choppy market, day trading comes way more into play, and you can just capitalize on quick pops in a stock, take that money, get out after that stock broke out of some kind of intraday pattern, lock in your profit and move on. So that's one benefit of day trading. Next up is intraday charts provide sooner buy triggers. Not always, but a lot of the times they can. When I'm looking at a stock, say in a revival pattern that has yet to actually break out of that neckline trigger on the daily chart. Sometimes if you look at the intraday chart first, you're going to see an intraday chart breakout before it actually hits that breakout trigger on the daily chart. So that's kind of the whole example of combining these two together, and why it's such a better strategy, and why that's what this whole DVD is about intraday charting, is that so you can kind of get in and kind of see that breakout before it actually happens on that shorter term scale, before it actually hits the larger term breakout on the daily chart. So intraday charts provide you with much shorter term and quicker potential entries and exits into a stock. As I said, here next up, what I was going to talk about is provides quicker selling triggers, potentially lock in better profits because you saw something on an intraday scale that looked like the stock was not going to be working out, so you got out of the stock very quickly, locking in the profits. Or as I just showed you in that example before on ROSG, it provided me with a very quick stop loss. Once that intraday chart broke down, that was kind of an indication that the daily chart wasn't working out, that revival pattern wasn't going to happen. So I used that intraday breakdown to get out of my position, cut my loss at about $6.90 when the stock actually went down almost to $6 per share that same day. So intraday charts provide you with a much shorter term level of getting in and out of a stock. As I'm saying here, more opportunities, but is that a good thing? Day trading, some people try to take too much advantage of day trading. They're searching too much, trying to make things that out of something that isn't really there, trying to find a multitude of different intraday opportunities. But you really need to focus on these patterns that I'm about to teach you, and really try to only stick to those. And I prefer and only try to trade stocks that have both the intraday chart and also that it's combining with a FUS4 daily chart pattern. So I try to combine those two together, and that's where things really come into play. If you're sitting around trying to just trade intraday pattern after intraday pattern after intraday pattern, you're likely going to be over trading. You're definitely going to catch some big intraday breakouts, but there's also a lot of intraday breakouts that don't work. So there's I try to find that combination of both time frames working together, of the intraday as well as one of the FUS4 patterns, the revival, gold, uh, survival, and force pattern. So there's going to be a lot of opportunities in day trading, but that's not necessarily a good thing in some senses, because that might lead you to over trading. Okay, but now let's talk about some of the downsides and negatives of day trading. Obviously, if you're a day trader, on the upside, there is, those intraday opportunities to make, a lot of money. So that's going to give you some more opportunities to make money. But on the other hand, it is going to make more opportunities available to fail. And, somebody that's failing a lot is going to have very high commission costs. It usually turns into kind of a downward spiral of over trading, and you dig your own grave if you're just sitting there trying to make something out of nothing. And so there's a lot more opportunities to fail as a day trader if you're just sitting there trying to make things happen when there's just not something there to be made to happen. So that is a negative of day trading. Some people just kind of get caught in this spin. They keep losing on a trade. They see something else pop up that's just kind of so-so, and they try to trade some half-ass intraday little breakout, and it just continues to fail. So you always got to be able to pinpoint and pick and choose the best of the best. Don't sit there and just try to make every little intraday pattern you see a money maker. Always pick the ones that look the best and be confident in the trade. Never go into a trade second guessing what you're doing. Always be confident in thinking that this is the right pattern. It looks good. I need to buy here because this is fitting the criteria. Never enter a trade that you're sitting there second guessing, saying this could be a really dumb idea, but I'm going for it anyways. So always you want to have confidence in your trading. Another negative of day trading is, in comparison to the FUS4 swings trading strategy, and this is something that I do myself a lot actually as well, particularly because the market is very volatile, is you get too focused on what's happening intraday in a stock, and you're looking at the 2-minute and 5-minute intraday charts, and they're going all over the place, and you can freak yourself out doing that sometimes when if you're more so focused on the just daily chart, and you see this is a perfect FUS4 force pattern. I need to just kind of relax and let this thing play out and not have too much anxiety about what's going on intraday. So sometimes when you're really focused on the intraday, you kind of lose sight on what the bigger picture is. And the bigger picture plays, the swing trades are where you make your biggest gains of the year. Those are the trades where you hold out for a little bit and let the actual FUS4 pattern play out, and watch the thing skyrocket over several days to a week or two. For example, let's take a look at a couple of trades that sometimes it was awesome that I took the very short-term trade. Other times where it was like, you're an idiot, this thing just ripped to the upside. So it's hard to gauge when it's good to be really focused on the intraday, but other times it's not. So first, let's take a look at ROSG. This is revival pattern that I was actually playing. I actually bought in on this day. I sold very quickly right here. I had 5,000 shares overnight. I sold into this spike and made nearly $4,000 on this trade. But I was focused on the intraday action, which is why I took my profits so quick rather than thinking, okay, let's just let this play out for a bit and see if we can kind of rebound and actually break out of this revival pattern and continue the upside. So there's upsides and downsides to the whole picture. Sometimes focusing on that intraday is going to save your ass, or lock in those quick profits that you want, because the stock might just actually flip and turn around like this stock ended up doing. That was all it gave us. It gave us that one quick spike to the upside. I bought down here, sold it on that morning pop, made $4,000, and then this thing reversed. So it would have been a horrible swing trade, but just for a 2-day quick ripper, that was a perfect example of locking in profits and getting out when I should have. ZGNX, this is one that actually just blew up again today. This was one that I bought in at 255. It was a revival pattern breaking out. As you can see here, lead-in trend coming in. Then we had this triangle that formed up. I got in at 255. I actually got stopped out on this day here, which it actually did. It basically just retested the midpoint of the breakout candle, but it broke out down below the previous day's low. I was looking at the intraday chart. I got a little spooked out, and I sold at like mid 260s, so I made like $600 or something. I think I had like somewhere around 5,000 shares on this as well. But in fact, this stock was a perfect FUS4 breakout as a swing trade. Came down, retested the 13 EMA, and then just ripped 3 days in a row up to 314. 350, 255 up to 314 on 5,000 shares. That would be a hefty, several thousand, 3,000 something dollar gain or something. But instead, I was way too focused on the intraday, got spooked out, and only made about $500-600 on this position. What was another one? This was another awful decision by me, which was PPHM. This was a revival play that I bought into at I believe right here about 60 cents. I sold the next day at 71 cents. I think I made like $1,500 or something, and that was my 1-2 game plan. Quick rip, I got in, I got out, I made a few bucks. But if you actually follow the FUS4 criteria, once these things break out of a FUS4 pattern, as long as they ride that 13 EMA, there's no telling how high they can go. This had a volatile day, and third day, and that definitely would have spooked me out if I was just sitting there focusing on the intraday. So sometimes you just gotta let these patterns play out, and that's exactly what happened here. PPHM went all the way up to what is the high here? 550 from my entry at 60 cents. I had something like 20,000 shares down here when we potentially this rode the 13 EMA all the way till it broke down at about 237. So could have been a huge run on PPHM there. Me being way too focused on the short term and just a little bit too cautious and having anxiety watching the intraday charts bounce all over the place. So there's upsides and downsides. I missed a huge swing trade here, but on the other hand, on ROSG, I turned a very quick false breakout, a $4,000 gain, which could have turned into nothing very quickly. So there's upsides and downsides to focusing on the day trading situation. Sometimes you're going to be very grateful that you did. Other times, you're going to be very ungrateful that you didn't just let that FUS4 pattern play out. It's kind of hard to gauge either or, but the ultimate goal is to combine these two, find a happy medium between these intraday actions as well as the daily chart actions on the FUS4 patterns. All right, so now I'm just going to do a quick refresher of, kind of the core strategy of the FUS4 four different breakout patterns. Just in case you didn't actually just watch the FUS4, just give you a little refresher before we kind of go into implementing the new day trading strategies into the core strategy. This little recap is not going to be anything about intraday trading at all. I initially started out only swing trading. It's because you could actually swing trade comfortably, way more comfortably back then. This was 2009. This was CPQQ in late December. I actually made about $15,000 on this stock. This may have been, my biggest gain. December of 2009 was also my biggest month ever. I made about $50,000 in 1 month. In December of 2009, Chinese stocks were hot. The market was just coming out of the recession, and so it was just perfect time. The stars aligned, and I just absolutely killed it that month, trading only FUS 4 patterns and swing trading them. And CPQQ was actually one of them. But let's kind of go over just what the anatomy of a breakout is. I'm a breakout trader. I trade triangle breakouts. It's nothing necessarily new or revolutionary what I do. I just have a system and a way to actually trade these patterns, and also there's different variations of the lead-in trend to these patterns that I kind of coin my own terms based on that. But this is all semi basic technical analysis stuff, but a lot of people have trouble executing these trades. Anybody can read a book on technical analysis, but unless you know how to execute the trade and set up plans and whatnot, all that stuff, obviously not everybody wins in the stock market. So I've created a system that works for me, and I laid it out in the FUS 4 DVD, and many people liked it. So let's just do a little bit of a recap of the FUS 4 core strategy. So for every breakout, there's 3 phases. Obviously, phase 1 is when we first kind of get some kind of hyper momentum going for the stock. There's usually some kind of news or something that pushes the stock, and there's usually volume plus price. Basically, we get a ramp up in price action, and we have accompanying volume. So there's an increase in volume. Phase 2, we actually get the consolidation phase, where the stock, you're actually able to start drawing the trend lines and building that formation. So you can see here in phase 2, the stock, peaked out in phase 1, coming back down. Then we were able to start drawing a trend line here in phase 2, also create that resistance neckline here in phase 2, and then finally in phase 3, the stock actually broke out here with accompanying volume and started trending along the 13 EMA. Ran from about $2 at the actual breakout point up to $4.50. I actually bought in at about $2.25 here and sold up near $3.75. And made a huge amount of money. Made about 15 grand on this stock CPQQ back in the day. But there's other patterns like this as well. My biggest trade of this year in 2012 was RPRX, which was actually an exact same pattern as this, which was a force pattern. And I made about a little over $10,000 on that stock. But speaking of force pattern, let's or not force pattern. Let's go over some tactics first. Basically about where I like to buy stocks, breakouts. First up is the actual physical breakout. So here on CPQQ, the actual breakout here was at $2 per share, where that neckline was. To buy after the breakout higher with a smaller position, that's potentially up here. As you can see, when you buy into these force pattern breakouts, sometimes it's risky to buy a full position up here, because it might just come all the way back down and be a false breakout and you lose a lot of money. So technically it's a good idea to buy in a smaller position. I actually bought in here and then started continuing to add. I actually added again here and added again up here on this secondary breakout on CPQQ, but my initial position was at 225, so I bought in late. I didn't get in right at that physical breakout spot. Back then it was much harder to get into that stuff. I didn't have strategies as well to create as good of watch lists and scans and stuff like that nearly 3 years ago. Number 3 is buying a dip near the midpoint of the breakout candle. As you can see here on CPQQ, this barely got a little bit of a pullback, but it did pull back towards the midpoint almost to the breakout candle. So the midpoint is basically just the middle of the actual breakout candle. That's usually technically a good area to be buying into a breakout stock. It's usually preferably the most ideal situation is when a stock breaks out like this, dips down in the middle of the session, hits that midpoint, and then rallies back up, and goes back up in the same day. And number 4 is a pullback near the 13 EMA, the 13-day exponential moving average. In this case, you never really got that opportunity to buy on that pullback near the 13 EMA. It didn't get back into 13 EMA upwards of till 325, but as you can see, it did come back, hit the 13 EMA support, and rallied it up $1 off that level from there. So the 13 EMA after a stock breaks out of a FUS4 pattern is a very bullish trend indicator. Now let's look at where I would typically sell breakouts. At first, when I buy into a stock, people are always saying, how high do you think it can go? Where are you planning on selling? First of all, I have no idea how high a stock can go. I'm not a psychic, but you can look at a chart. As for CPQQ, buying in at 225, the next whole number resistance is going to be $3 per share. So that's potentially where this stock is going to spike out, and you can see it actually did run up from 2 up to 3, stopped at $3, kind of consolidated in this area, formed up a flag, and actually broke out again. And once that broke 3, I actually even bought more. I just had a lot of confidence going with stocks at this time, and I was willing to let this thing ride out and see how high I could actually go. The 13 EMA hadn't broken down, so I actually added once this broke out above $3 per share, and then sold upwards of 375-ish as this started peaking out towards $4, because that was the next whole number. There was actually no physical resistance. This was a force pattern, and so my target was about $4 per share. Once we got close there, I sold in the high 370s on CPQQ. Breakdown of the actual breakout trigger, that would mean if this stock broke out of $2 per share of this great looking force pattern, if $2 per share eventually came back down and broke down, or if we broke out then all of a sudden we dipped again and started breaking down below $2 per share, that would be a good sign of a false breakout. So you want to sell if a stock starts going back down below the actual breakout trigger. Also, a pullback to the 13 EMA, and if it doesn't hold the 13 EMA, as you can see here, this did hit the 13 EMA, consolidated, and then bounced, but once it broke the 13 EMA the next time, it actually turned into a trend reversal. So always be watching the 13 EMA for potential trend reversals as when to potentially get out of a stock that you're swinging as a longer term trend swing trade. Alright, so first up is the force pattern, my pretty much favorite pattern of all the FUS4s. Basically what a force pattern is a three-phase breakout triangle, but the lead-in trend is either neutral or bullish. So the stock is already either bullish or it just hasn't really been doing anything for a while, and so a recent breakout definitely means something is up, and that's something that could just all of a sudden just spark up a huge flare and this stock might just rip. So as you can see here in this example of GGAL, this is back in early 2010. These are actually just slides from the original FUS4 DVD, just to kind of recap what the force pattern, or the FUS4, all of them are. But in this case, is the force pattern. You can see the lead-in trend here is kind of neutral to bullish, and then we get this great-looking three-phase breakout triangle formation that actually broke out. From here, this actually just ramped all the way up from about mid-6 towards $9 per share. Rode the 13 EMA the whole time. Hit that whole number resistance up at 9, consolidated again, actually formed up 2 more force patterns, and just continued to break out hard every time. Then it finally broke out here again and ripped all the way up towards $16. So another 50 to 60% run on the third phase of this force pattern breakout. So force patterns are very bullish. These are the ones that you can definitely use the 13 EMA and just ride it out, see how high these stocks can go. So here's a couple more force patterns. Is TGA, you can see lead-in trend neutral, followed by this three-phase breakout up at about 5, ran all the way up until about 7 something up here, but basically we kept bouncing off the 13 EMA, you can see, before finally breaking down, formed up another force pattern and actually ripped at $8 per share. Again, you can see this was using that whole number as a resistance zone. Once that broke out, this thing nearly doubled and basically rode the 13 EMA trend almost the whole time. Got a little choppy right around here. Obviously the 13 EMA isn't perfect, but it's a pretty good indicator to have in your arsenal, kind of use as a short-term trend indicator. RNN, here's another just force pattern, neutral trend coming in, huge phase 1 here on volume, phase 2 consolidation, finally broke out at phase 3 with volume, and this thing just flagged and then just ripped it up here over 100% on volume. Next is survival. Lead-in trend is basically, a stock has a huge run up here on volume and then sells off pretty hard and then kind of forms a mini three-phase triangle, which usually leads to a breakout that can actually retest that prior peak or even break out higher above it. So here was PCBC actually traded this stock as well. We had that huge run up and then all of a sudden a huge sell off, and then actually came back down and retested that 13 EMA support, formed up this nice little triangle pattern here. I bought in, as this was breaking out. It was also hitting that $2 level, so it was a potential breakout above a whole number. First initial target on a survival pattern is the previous spike. So this kind of peaked out here up around the 240ish. Actually had another whole day of a run there, but I believe I sold right around in this area. So that would be your first initial profit target area on a survival is short-term profits is that previous spike. Here's another survival pattern on WAVX. Got a huge run up, phase one here, kind of a sell-off, hit the 13 EMA zone, formed up another little triangle pattern here, which eventually broke and then ramped up, hit that previous peak, and then actually just continued to rip it up here before finally kind of reversing down the 13 EMA trend. Same exact pattern over here on the survival. Big run up, followed by a triangular formation that broke out, retested, and hit that previous peak. So that's the survival pattern. Basically, I call it survival as, it gets a big run up and then doesn't actually just collapse and die. It actually survives that first initial trend, but reforms a mini consolidation here. And that actually, potentially either is going to spike out here, and that's all you're going to get, or it can even break out above that level and continue to run up. Next is revival pattern. This is definitely probably the most common pattern. So it's definitely going to be, not the most reliable of the four patterns because there's going to be so many of them out there. There's going to be a lot more opportunities for this stock to fail. But, don't let that, discourage you from trading a revival pattern, because some of these revivals make huge runs here, as you can see in this example on REDF. Basically, a revival pattern is a stock that has a lead-in trend that is bearish, so there's a reason why this stock is down here. Selling off hard. So that's one of the other reasons why revivals don't work out as consistently, is because there's something wrong with the stock. There's a reason why it's been selling off. But a revival is basically saying the stock is reviving itself. It formed up a pattern, built a base, and now looks like it's potentially getting ready to reverse and potentially making a huge run. And the way to look at a revival is basically a lead-in trend that's followed by a formation of a three-phase breakout triangle candle or pattern, and that's what's going on here on RADF. Lead-in trend is bearish, keeps going down and down and down, finally forms up this triangular pattern. Once that broke out at about 225, this thing just ripped all the way up to 625 and actually never broke down the 13 EMA upwards near $5 per share. You can see it retested at about $3 per share, but just continued to rip it up here. Here's another couple of illustrations of revival patterns. Up next is the gold pattern. This is one that you can basically make the quickest. This is gold. It's worth its weight in gold. Like, you can make the most amount of money in the least amount of time. The gold patterns is the dollar roll stock. Some of these stocks that hit that dollar roll make 100% gain in a very short amount of time. Basically, a gold pattern is a stock that's been trading under $1 per share for 9 months to 2 years. Longer the better. Once that breaks out of that dollar level, this stock can typically make 100% run up to $2 per share. And then up in the nose of the maybe this was a 2-year resistance level. Usually up in the nose prior to that breakout, there's potentially a smaller triangle that kind of give you another indication of that actually breaking out. So let's look at some examples. Here's CHTL. You can see this stock was trading under $1 per share. I actually made decent money on this stock as well. I think about it about $1 and ended up selling it in like the 130, 140 levels, and this ran all the way up to 2. It's very hard to hold one of these stocks all the way up to 2. It's just nerve-wracking. You have a bunch of profits and you want to take them, and a lot of the times force a pattern's not going to work out, and all of a sudden you just had a stock at 140, and next thing you know, this thing's down below 1, And so, you always got to be taking your profits on these stocks, but sometimes people can have that patience and they get lucky and actually catch one of the big winners. But basically, you can see here on this CHTL, this had been bouncing up towards $1 per share for quite a while, almost a year and a half here, before finally breaking out above 1. If you look at the shorter term chart, this is basically just zoomed in right here of this little section. You can see this had this kind of mini consolidation triangle formation that actually broke 1, and that was when I bought in. And I believe I sold up here about 140ish after we had just a huge 2-3 day rally here on CHTL. So that's basically, this is a picture perfect gold pattern, a stock that had been hitting 1 for a while, finally leading up into 1 again, had this nice consolidation with this triangle breakout, and ran all the way up, peaked out right at $2 per share before coming back down. Here's another one, ESPH. This is another one that I actually traded as well. This one actually wasn't hitting right at $1, but it was a stock that had been trading under $1 per share. Basically kind of the same pattern. It's basically kind of a force pattern that formed up just at a very low price. So we had this spike up here around 70s, hit here again. We actually had a great looking force pattern on this level. When you zoom in on this section, we have this great looking triangle here that broke out above 70. This thing just continued to ride the 13 EMA all the way up to 130, but not before actually spiking out up near $2 per share. So it's always good to be taking profits on strength as well. Otherwise, you're never going to sell a stock near its top. Okay, so now we're going to get into the new stuff, basically the kind of intraday strategy stuff. This isn't the core of my intraday stuff, but this is a little tactic we call the red to green move. A red to green move is basically when a stock opens or drops below the previous day's close and then crosses back up above that day's close. So basically, just as it sounds, the stock went from red to green on the day, and that usually means a potential sign of continued momentum going forward. So let's take a look at a couple examples, and then I have a previous video from a while ago that you'll also see here in a second on just a couple of actual live trades that I made just based off the red to green move alone. So here's an example of a stock called BIOF. This is Biofuel Energy. So as you can see here, this is the daily chart over here. Over here is the 2-minute intraday chart just for one single session, starting here. And we're looking at this actual one-day candle here after this had that huge sell-off. So as you can see here, this stock actually opened below the previous day's close, which is the bottom of this candle right here. So this stock opened in the negative territory, as you can actually see over here. This is the previous day's close. This is my charting software, TC2000. What I love about it so much is that it gives you this yellow line on the previous day's close, so it just gives you a really great indicator on looking at an intraday scale of the actual red to green trigger. So basically this yellow line gives you the trigger of when that stock's actually crossing into the green territory. And as you can see here, this stock gapped down and opened up below, and then actually got some buyers in, formed a little mini flag pattern. This could actually be considered a mini F pattern, which we're going to be going over next, which is kind of the cream of the crop of my intraday strategy. So sometimes a lot of these red to green moves that open below first form up a mini little F pattern below the actual red to green trigger, which is right here at about 595. So it kind of gives you a heads up as a potential, hey, maybe this stock is going to actually push green here and find some momentum going forward. So here on BIOF, it formed up that little mini pattern. Once that broke out that green spot from going red to green, this thing just started to fly from about 595 all the way up to about 665. So a nice push there. Rode the 13 EMA on the 2-minute intraday chart. Also I'm also following the 13 EMAs on my intraday charts as well, which we'll be going over. But just here's a little example of the red to green move on this particular stock. Here's another one, NIHD. This is basically the opening of the session right here where this yellow line starts. This is the previous day. This is the current day. So as you can see here over on the daily chart, this actually pulled back towards the 13 EMA, right into the gates You can see this thing spiked up for a second, but started going red pretty hard on the day here. Actually came down and retested the 13 EMA, which is our always trusty trend indicator. And this was actually a revival pattern here previously that broke out here at about just below 7. Broke out here, came back down, retested the 13 EMA. So, we had multiple catalysts of potential reasons for this to bounce here. It was a revival pattern post breakout, came back down, retested that 13 EMA, just tapped it perfectly. But on the intraday wise scale, for another indicator of this potentially being a buy here, I actually sat here and talked about this stock all freaking morning on Foos TV, and even when it was breaking out here, going red to green, and just never had the guts to pull the trigger on here. So I totally missed this trade. But as you can see here, this went red on the day, rallied back up here, went green. So that was a potential buy trigger, especially since it was bouncing off the 13 EMA of a revival pattern. And now look at what happened that same exact day. Once that broke red to green, this thing just continued to rip it up here. You can see this also rode the 13 EMA on the 2-minute chart. Had a quick little slip up here. 13 EMA is never going to be perfect. It's just kind of a good indicator of a good trending stock. So you can see NIHD ripped that red to green, also broke above yesterday's highs. So there can be multi-day breakouts as well. Just between 2 days, you're looking right here, you can't see a breakout here just looking at these 2 daily candle stocks. But if you look over here on the intraday scale, you can see that this actually kind of had a intraday 2-day breakout here. That also was a red to green move. So, there's multiple catalysts here. This thing just absolutely ripped up from about about 762 all the way up to 828 at one point in the same session before finally breaking down the 13 EMA on the 2-minute chart. So that was another great example of the red to green move. Okay, so those were both, kind of rebound stocks. The red to green move basically works in any kind of situation. I don't just look at any stock that's in any pattern and all of a sudden a red to green move happens and I flip out and want to buy this stock. I'm still only looking for stocks that have a lot of momentum, or stocks that are in Foos 4 patterns, or stocks that are pulling back towards potentially the 13 EMA that actually were breaking out or just did break out of a Foos 4 pattern. So don't go searching for red to green moves all day long on just random looking stocks. They have to be stocks that already are fitting good criteria, or stocks that have been ramping up really hard on news and have a lot of momentum. So looking at INSM, this actually had another huge red to green move today. You can see the stock was already up significantly from about 3ish up to 540. This stock actually dipped down red briefly this morning, and then once it triggered back green, this thing just ripped it up today all the way up to 630 into the close. So you can see here, this was the opening bell right here on October 4th. Went red on the day. So that causes people to panic a lot. And the thing about that is it's hard to say how much momentum this stock is going to have. Once the stock starts going red after a huge run up, a lot of people decide hey, this is getting iffy here, maybe I'm going to get out. And sometimes the stock just sells off. But once it goes green again, people that were potentially trying to go short or thinking short have to cover their shares because they freak out, and potentially new buyers come in on the red to green move. So that causes a huge short squeeze and new buyers come in. So you can see here, went red briefly, came back up. The stock had a huge amount of momentum and just ripped up again all the way up to about 630 today. And if we look even closer on the daily chart on INSM, you can see that this pretty much went red to green almost every one of these candles before it actually ripped. So you can see here was the closing price. The stock actually dipped down right in the morning and then went green on the day. Same thing here, the stock actually dipped down in the morning, went green on the day, caused another panic, buying pressure. On this one, the stock actually opened below the previous close. New buyers came in. Once that hit above yesterday's close, this thing ripped forward, and then finally today we actually had the biggest rally of the day, up 18% right here. Once that went down red, once that went green again, this thing just ripped all the way up here. So the red to green move is definitely a potent intraday indication of potential momentum going forward. But there's got to be certain criteria that don't just look at any random weird stock that has no prior pattern formation, and see a red to green move and start flipping out, thinking that this stock's gonna all of a sudden, rally 20%. So there's got to be, pre configured criteria